Subscribe to our YouTube channel and press the bell icon to get the latest updates.
As a kid, did you often wonder how would it be if you could actually be a part of your favorite science fiction movie? If you could actually travel in spaceships, talk to robots, or ride in flying cars? Trust me when I say that some of the old science fiction movies were truly futuristic. One particular name that comes to my mind is the movie 2001: A Space Odyssey, released sometime in 1960s. So the makers of the movie actually showed a chip-enabled video call 50 years back. And guess what? The video calling service in the movie was called Skype. So the hunt for disruptive technology has been around for ages. Even investors have had their eyes on such technology for long. Venture capital and private equity investors who swoop in early into such disruptive tech businesses are perceived to be very privileged. One might believe that they dream up all kinds of impossible technologies and back investors or businesses which test them. Well, that's not how it works. Rather, the VC mindset is very evolved. And so, it is very important that you as an individual investor understand this mindset to get the same advantage. Hi, I'm Tanushree Banerjee, editor of Equity Master's Blue Chip Recommendation Service, Stock Select. Welcome to Safe Stocks, where we discuss ideas to create and preserve wealth in the safest businesses. If you haven't subscribed to the Equity Master YouTube channel yet, please do so and click on the bell icon to get notifications for my latest videos. So coming to the VC-like mindset of buying disruptive tech businesses. Who do you think has been one of the most successful VCs in the world? Alphabet, as in Google, has used acquisitions to expand its workforce and launch new products well before it was a household name. Many of Google's most well-known products, including Android, YouTube, Maps, Docs, and Analytics, have all originated from acquisitions. And remember, these were all very early stage VC-like investments. So Google has been pretty successful VC-like business. And you'll be surprised to know that for Google, it wasn't the size of the acquisition that mattered. Rather, Google uses what it calls a toothbrush test to see if the technology is worth investing in. If you ask Larry Page, what does this mean? He would tell you that he basically tries to evaluate if someone would want to use the product twice a day and whether it would make life better. Essentially, whether the product or service would be truly in demand and whether the invested capital will fetch the desired returns. Similarly, it is possible to evaluate new disruptive businesses on certain parameters. The VC mindset is all about taking several very long-term bets. So what do the VCs look for? Of course, every venture capitalist does have some unique parameters to judge potential investments. After all, they invest a couple of crores at a time. But most of these parameters are no rocket science. And you as a retail investor could look for these parameters to make pretty good judgments when you evaluate disruptive businesses for your own portfolio. Here are 9 factors that could help you develop VC-like mindset. Let me take you through them one by one. Whether it's a truly innovative product or service. Now, Me Too products and services or ones operating in stiff competition have very little chance of growth without burning cash. You typically see such businesses offering massive discounts, cashbacks, etc. to attract users or spending massive amounts on advertising. The journey to profitability for such a business is bound to be very long. What is the total addressable market of the product? Let us take the case of Zomato. Zomato's business model is neither innovative nor groundbreaking. It resembles other online food delivery businesses in other parts of the world like DoorDash or Uber Eats in the US. So the allure for investors is Zomato's huge potential for growth in the Indian food delivery market. Like the company showed in its IPO prospectus, the penetration of online food delivery apps in India is still very low. And therefore, the venture capital mindset is to ride such growth opportunities from an early stage. What is the conversion rate? Here again, we are referring to the number of free users who actually go on to pay money to the company for its services. For instance, if out of every 100 Zomato users, 10 go on to buy a Zomato Gold subscription, then the conversion rate for the company would be 10%. The higher the conversion rate, the faster the company moves towards profitability. Hence, VCs particularly are keen to keep an eye on this parameter. What kind of cash flows does the company have? And if they aren't positive, what is the rate of cash burn? In the technology business, it is very easy to buy out some businesses with innovative products or services than trying to incubate more startups and then innovate. Therefore, it is not just Google but also Facebook, Apple, Amazon and Microsoft that have been acquiring smaller businesses over the years to add to their suite of offerings. Most of these buyouts are not cash accretive in the initial years. You will be surprised to know that even YouTube did not make much money for Google in its starting years. But over a period of time, it went on to earn billions for Google. Having said that, as an individual investor, you may not have the appetite for such cash-losing businesses, so you should stay away from them until they become cash flow accretive. The next 2 points, strong management team and capital allocation plan, are connected. The VC mindset involves betting on businesses with massive macro tailwinds and betting on the execution capability of the management. Without these, there is no room for exponential profits. What about the detailed capital allocation plan? Well, such a plan tells the VCs if the promoters plan to keep on debt on books, raise more capital, undertake capex, dilute equity, etc. And these are extremely important decisions for the long term. Whether the business has some downside protection. Now here, if not all, at least some VCs insist on keeping some assets of the business as a protection in case the growth plans go awry. Of course, such downside protection could only help if the business faces temporary headwinds. And finally, the 2 most important metrics. Whether there is a sustainable megatrend, which means the total addressable market itself is bound to grow for decades. And if all goes well, if the business has at least a 10x upside potential. For this, the company in question cannot be a fringe player in a hyper-competitive sector. The VC mindset demands looking for nearly monopolistic businesses offering innovative solutions. You'll be glad to know that as more startups try to raise capital at an early stage over the years, the line between VCs and individual investors is getting blurred. In fact, even VCs now encourage their portfolio firms to go public, as in get listed sooner, and then continue to hold on to some of the shares in the listed companies to ride the post-listing upside for years. So that is exactly the opportunity you as an investor need to look for in disruptive tech stocks. And as long as you develop the correct mindset, this segment of the market has massive upside potential. Hope you like this video. Stay tuned for more such videos on creating wealth in disruptive tech stocks. Thanks for watching.